Hello, everyone, and welcome to the Master of Money program. I'm Steve Beeman, your host. And whether you're joining us live at the Meetup Group in Oak Brook, Illinois, or through the streamed video going on throughout the internet around the world, we're glad that you devote this 1/2 hour to us as we try to teach everyone how to become a master of money. Thanks for spending your time with us. Tonight, we've got a really great program. Several weeks ago, I mentioned to you that I was trying to secure a guest for the program, a guy named Geoff Garbacz. Geoff is a principal at Superstock Investor and the managing director at Quantitative Partners. He's a resource from which we get a lot of our tools here at the Society. Well, Geoff finally, braving this Midwestern weather that we're having, drove down today from Madison, Wisconsin, and he'll be joining me for the second half of the program. It's going to be very interesting as we extract everything we can from Geoff, the good, the bad, and the ugly. So stick with us for the second half of the program. I think you'll be well served. Now, last week, you and I spoke about disruptive technology. We spoke about the speed at which technology is changing our lives, and we spoke about the types of technologies changing our lives, from robotics to 3D printing to ubiquitous computing with semiconductor-based everythings. Well, we also talked about the impact on labor and the economy in general. But I also gave you at the very end of that show a tip on an ETF you could buy that will help you participate and make money on that massive transformation coming down the pike. So we know you found it interesting because I got a whole bunch of questions about that written to us, and we're glad to answer them. So if you have questions about our program, write us at questions@safefinancial.org, and we'll try to get that answered for you. Now, in addition to that, we touched on our Superstock Investor program, and we began discussing with you something called the Safe Sponsored Investment Club, or the Safe Investment Club. This is interesting that we've brought it up because the question that I want to answer from our viewer last week was, Steve, what is a Safe Investment Club? How do I participate in it, and how do I learn from it? Well, very simply stated, what we're trying to do at the Society is create something that you can use to tangibly implement what we're teaching you and the tools that we bring to you. So for each of our communities where we have a meetup group, we're going to begin establishing investment clubs. These will be groups of private individuals coming together through the meetup group that then pool their money together and implement the strategies and concepts that we teach. Now, there'll be a low minimum to enter, so there's not going to be a financial burden placed on anyone over and above their own ability to participate. But we think that's a really nice way that you can directly implement what we're teaching you here. Now, as we build a network around the country of these meetup groups, we hope to have a Safe Sponsored Investment Club in many of the cities around the country. If you'd like to have one considered for your neighborhood, write me at questions@safefinancial.org, and I'll look into establishing a meetup group in your backyard, and then we can sponsor perhaps a Safe Investment Club right there. So keep those questions coming at questions@safefinancial.org. Geopolitically last week, the big news of the week has to be Greece. With the election of the Syriza group, Greece has taken a wild swing to the left. What this group is basically promising, or threatening, however you want to look at it, is to unwind the austerity programs placed upon them by the European Union when they loaned Greece money. Greece has been a financial basket case for a number of years. As part of the bailout of Greece, the European Union put strict austerity measures on them. They privatized industry, they cut minimum wages, and they cut government positions and staffing. Well, Syriza has come in and said, now as the power group, we are not going to have austerity. We're going to raise the minimum wage back up. We're going to reinstall all these government positions, and we're going to take ownership of some of these privatized businesses. Now, more than that, they said very flat out to the Germans, and we're not going to repay the money we owe you. Now, if you're Germany, you're not going to be real happy about that, and this could be another little kink in the fiber of the European Union. We talked last week about Switzerland taking its currency off the EU so that it floated it against it. And that was another real problem for the EU, but this Grecian situation could be serious. How do you handle a rogue country within the European Union that thumbs its nose at you when you've loaned it billions and billions of dollars? Well, we're going to have to see what plays out. But as has been the case for the last 5 years, Greece once again comes up with a bit of a problem. Now, notwithstanding that, we still think Greece is a beautiful place to visit. Some people very close to me and very special to me want to go visit those little islands for their vacation, so we want to keep the tourist open with Greece. But the fact of the matter is they're in real trouble, and we don't want to see that catalyst throughout the European Union that causes their recessionary problems to become worse. Because the second geopolitical event I want to talk about, once again, goes back to Moscow. Vladimir Putin's Moscow government is making very aggressive inroads into the Ukraine once again. Now, if you follow this, you know that the Ukraine has a large portion of it that's Russian-speaking. So Russia has for a long time said that's part of Russia nationally. Well, the head government in the Ukraine is a West-favored government, and they want to become part of NATO. Well, they're not part of NATO yet, so we don't have the treaty obligations that we might otherwise have. But Putin is making very direct statements as of last week of going in to take out all of Ukraine. Now, he's got power to do this because he can go to the European Union and threaten to cut off their natural gas supplies. Well, we'll have to see what he does. But in light of Greece, in light of Switzerland, this Russian incursion into the Ukraine creates more geopolitical questions. And then finally, the House of Saud lost its ruler, King Abdullah, this week. Now, King Abdullah has been the king over the Saudi Arabian kingdom for quite some time, going back even to the 1970s when the United States virtually guaranteed the House of Saud's security in return for a petrodollar-based economy. In other words, as long as oil is based on the dollar as its value, we would protect the Saudi royal family. Now, there are a lot of questions about what's going to happen now as the Saudis transition power and how they'll stay in the U.S. camp or not. But we want to keep an eye on them and make sure that they don't fall victim to what is becoming Iranian aggression or other Middle Eastern problems, or sway away from the United States into the Chinese camp. And the Chinese are aggressively trying to persuade Saudi Arabia to become more in their camp than ours. So we want to obviously keep an eye on Saudi Arabia and watch that. But as the king now passes away, a generation changes in Saudi Arabia. Now, economically, the most important news must be the meeting in Davos, Switzerland. This is a meeting that happens every year, and it's the heads of the governments, the academia world, business communities, technology communities. They all come together and talk about the very same things you and I talk about on the Master of Money. They talk about global income disparity. They talk about building up the impoverished parts of sub-Saharan Africa. They talk about technology and how it is freeing countries, but also dangerous to be used by government. They talk about techno-terrorism. So they talk about the same things you and I talk about. Well, they're not going to come up with any grand solutions. We believe the solution is done one person at a time. It's, for example, through the safe investment clubs. But we think in Davos we want to watch that, and the reason we watch it is because some of the academic ideas they come up with can be translated into policies at the national level. And we want to make sure that we're on top of that so we know how economically they'll play out for you and me. Secondly, U.S. prices continue to fall in December. We did see a rebound to the housing markets, which again kind of looks to an improvement there. We're glad to see it. As we said, the dropping oil prices have caused prices to come down, which has caused kind of a resurgence of consumer activity. We want to see if that continues, and we want to make sure we watch it because as Europe now is recessionary, China has slowed down, the U.S. is about the only bright spot in the world. Now, that's a good thing, and we like that, but we want to keep a close eye on it, especially with the housing market seeming to make a comeback. That's all good news. Unemployment seems to be coming down, although we've talked about that's a mixed bag. You've got a lot of part-time jobs and a lot of minimum wage jobs coming online. Again, this barbell economy being seen more and more real every day, where we have wealth and poverty and less of the middle class. That's a frightening thing, and we want to keep an eye on it because that could spell the death of the migration from poverty to wealth, and we in the United States don't want to see that. In the financial markets, pleased to say for the first time this year, the financial markets all ended positive. They rebounded off what was a very problematic start for the beginning of the year, and we saw the indexes all come back into positive territory. The big picture indicator from our friend Phil Erlinger research is actually in the positive, so there is a positive bias to the markets right now, and we would expect that to sustain for just a little bit longer. Now the VIX, that oft talked about volatility we measure that we look at that spiked up so high in December, the VIX traded down another 8% last week. So it's trading down around $16 or so. And we want to keep an eye. We watch that because it tells us where volatility is in the market. And that is indicative that the institutional players aren't seeing volatility. Now tonight, I'm very pleased in the second half of the program to bring Geoff Garbacz to you. I've known Geoff for 25 years. Now that truly dates me, but I've known him a long time. And he is a professional in the investment industry. He's well known and respected by the major hedge funds of the world, and I mean the major hedge funds. He's the managing author or director at Superstock Investor or principal at Quantitative Partners. He manages very selected monies for people using option strategies that are very sophisticated. And when we come back from the break, we're going to pick his brain and try to get everything out of him we can. Now, on that note, last week we got a lot of really good feedback about me running that Newsmax interview as the commercial, or the little break we have. So we're going to do that once again tonight, so we hope you enjoy that. But stick around, relax, be comfortable. When we come back, we're going to introduce you to Geoff Garbacz. Stick around, we'll be right back.
It is just amazing how we have blown retirement planning since 1974.
You know, I would take the other side, Tom.
Please.
I would say that the system is evolving, and, you know, if you look at the best performing defined contribution plans as an example, they're a really terrific vehicle for people to save for retirement.
Sunshine and roses for those thinking about retirement this day. Despite some minor issues, the American economy is getting better. Things are looking up, and you should be thrilled that there are few problems, if any, with any thoughts of kicking back and allowing your golden years to kick in. Remain calm. All is well. Now that we have dispensed with the flowers, we unfortunately have to dig into the weeds, because this current recovery is indeed working against you and all those wonderful thoughts. Okay. Welcome back to Midpoint. Veteran economist and chairman of the Society to Advance Financial Education, Steve Beeman, who's going to try and put a smile back on our face after all that. Steve, I'll tell you, you read that and you see these notes where it says America's recovery is working against people trying to retire, and that's where you want to throw up your hands and go, what's next?
Well, I'm not real big on those headlines, Ed, and thanks for having me as always.
Always.
You know, the reality is the Americans in general lost a great deal of their net worth when the real estate bubble popped in 2008 and 2009. We all felt it. We all see it. But in the last years, although real estate has been slow to come back, it is coming back. And for those that are, let's say, 50, 55 years old, the reality is that real estate value will likely come back and won't affect them. Now, with that said, all is not roses. The American consumer has not been much of a saver over the last 20 years, and that's going to hurt these people when they hit the golden years.
Well, isn't that basically because a lot of people never saw the reason to save? Because for so many years, and I guess in generations, we always thought there's Social Security, there's savings, there's my house, there's my car, there's so many of these things that I actually have moving forward. But then the housing bubble, but there had to be more than just the housing bubble that kind of burst that whole bubble, right?
Well, there's a lot, and this goes to the core of why this society was built. In fact, if you go back to 1974-75, we had the implementation of the ERISA programs, which some have referred to as every ridiculous idea since Adam. We'll leave that for another day. But that changed American retirement from the defined benefit plan to the defined contribution plans, the 401k world. Well, the problem with that is the Americans that got those plans weren't necessarily educated in what they needed to know about how to manage those plans. So they haven't performed as well. And to your point, people rely on things that may not be there, so they're not saving the kind of independent funds they need to save.
What were we not told then that would have been good for our education at that point getting to today?
Well, I think investors in 401ks should have been told how mutual funds work, for example, how mutual fund expenses work. I think they should have been educated on the value of an index fund if you're not going to actively manage your programs. And I think if we had done that, a lot of people would be a lot better off today. There's a great deal of evidence that those who did properly manage their 401ks have thrived and prospered and have net worths well above that $500,000 mark, which is kind of the minimum to pull off a good retirement.
Aren't we getting to the point now, and this is, I guess This has been a discussion for many years where it says Americans are living longer, we're working longer. And now there's some articles that I see and some experts who say, well, why not work until 67 years of age now in order to make up for what you lost in the bubble? Is that logical?
Well, actually it is. If you go back to the whole concept of retirement, this is a relatively 20th century phenomena. It was created officially, let's call it in the 30s and 40s, with an age of 65 years old, because that was an average person's life expectancy. Well, today we're living to 80, 90 years old. So it does make some sense to boost up that age in our productive life to 67. I would argue even for those coming into the retirement systems today that probably 70 to 72 is a reasonable amount. We shouldn't really plan to live the last third of our life on accrued wealth unless we've done really well.
But about 30 seconds and then we'll take a break, come back, do more. Isn't it, though, getting to 70 difficult because there's a lot of places that don't hire people even over the age of 55?
Well, that's a structural change in the economy, and I think what you'll see over time here is the internet changing how people work, and the millennials coming into the system know how to work in that environment, and they're the ones who will have to do that.
All right, I know you've got some ideas on modernizing the economy, at least modernizing the notion of retirement. We'll get to that in a moment. Stand by. Second Shot with Steve Beeman right after the break. And at 51 minutes after the hour, in Telling It Like It Is, a very different way to mark Veterans Day. Many people say we celebrate Veterans Day, but there's at least one who says that's the wrong word to use. And then again, it's not always about war. Many times it's about coming home. That, again, is my commentary in Telling It Like It Is. That's coming up. So's much more. Right here on the fastest 3 hours in news, Midpoint. We will continue.
Welcome back, everybody, from that short break. And once again, I'm so pleased to have you with us on the second half of The Master of Money. We're joined tonight by my very good friend, Geoff Garbacz. And as you know, I've spoken very highly of Geoff in the last programs, anxious to have him on. He's a consummate professional who has decades of experience working with the very best hedge funds and money managers that exist. So he not only understands the investment process, and he understands trading, but he understands research. So here is a resource for the masters of money. Let me welcome Geoff Garbacz to the program. Geoff, thanks for being here.
Thanks for having me.
Now, I've spoken at length with the people at the Master of Money about your background and how I think you really have some experience they need to know. Can you give us a very quick rundown on what your background is?
Sure, no problem. So when I graduated from college in 1986, I went to work for an independent brokerage firm and started learning about independent research as opposed to traditional sell-side research. And that's where I've spent pretty much my last 28 years working with independent research vendors as opposed to working with a traditional sell-side analyst.
And so you're putting research into money managers' process. And in full disclosure, we met through my work at Chicago Investment Analytics.
Exactly.
And we worked together on that. But after you spent a lot of time doing that, you then broke off a little bit and established Superstock Investor, Golden Energy Options Advisor, and Quantitative Partners.
Yeah, so that's kind of an interesting story. I had been a subscriber to a retail newsletter called 21st Century Investor. And they were putting out, this is in 98 and 99, putting out great picks, one stock after another, huge gains. And then 2000 happened. And at the beginning of 2000, our research kind of told us that we were going to run into some difficulty. I called them up and said, hey, you guys should be an institutional client of ours. So they became an institutional client. 2 years later, myself and Phil Erlanger, who I work with, we created a retail newsletter called the Erlanger Squeeze Play. And it just took off, mainly because of the fact that Phil had 18 winners in a row. So that's how we moved into the retail side of the newsletter business.
Now, Phil, you and I have talked about on the Master of Money program, he was chief market strategist for Fidelity Investments, right?
Right. He ran the technical research department. The place where people, when they go to Fidelity, that's probably the quintessential place where they go. It's a room that's half the size of a football field and just filled with charts.
So he's one of these rocket scientists. And through the work you do with him, you now offer retail investors access to Phil's work.
Exactly.
And then you added to it work with James DeGeorgia.
Correct.
How did that come about?
James is I call him kind of like he's a wonderkin. He was a coin strategist when he was 12 years old. He learned the coin market, and then he's morphed into all sorts of different things. Gold. He's moved into nutraceuticals. He's a very interesting guy, and once he establishes something that he's interested in, he just keeps moving into it. And I've done a number of research products with him over the years.
And now you are managing editor of Golden Energy Options,
Golden Energy Options Trader,
and super stock investor.
super stock investor,
And-
as well as on the options side, options index trader. And at the beginning of this year, I just took over doing blue chip options as well.
Okay, now, we've spoken a lot about options and how they're frequently misunderstood, but they're truly able to juice up returns if you know what you're doing. Just to make this a little bit sexy, give us a little bit of understanding how you're doing with your options trading, your hit ratios and your winners and losers.
All of our products have had a batting average in excess of 80%. One product was started in 2007. The other product was started in 2012. So 2 years on one and approximately 8 years on the other product.
So, folks, we're talking about 8 out of 10 trades are winners. That's an extraordinary, extraordinary track record. Now, Geoff, as you've talked with investors around the country and you've worked with people on the retail side, the institutional side, what is, if you had to identify one thing that those folks make as a single biggest mistake, what do you think that would be?
People don't have a process. People need to have a process for how they do what they do. And I don't care if it's mom and pop individual or it's the best money manager in the world. If you don't have a process, it's going to trip you up at some point in the cycle.
So we've talked, and you know that's my background of quantitative research. I believe that you have to have a process for everything in life. You're suggesting that the average person who goes into this trading world and they go see a seminar and so they get all excited, I'm going to go trade, I'm going to go trade. They fail because they haven't employed the proper process.
Right. They need to develop a process. They need to figure out how to create a process. And then they constantly need to see how the process is doing and improve. I'm constantly trying to improve my process. And I've seen it with clients over time. I mean, managers that would be managing $10 billion one year, and the next year they're running $500 million because they didn't have a process and they made a big error.
Let me ask you a question. Of the people you see who employ processes, and third party typically, how many of them fail because they don't follow the process?
Oh, that's a huge percentage. The big problem becomes the concept of confirmation bias. And so instead of letting the data drive how you're doing what you do, you go and seek out data that confirms your belief about something. Like, I believe the stock market should be down 20%. So you go find the data that would support that, as opposed to constantly looking at data and seeing how the data is going to figure out whether that makes sense or not.
I can tell you firsthand, I know someone who trades as a day trader every day, and their biggest problem is they're overly optimistic and overly pessimistic at the same time. So if they lose money, they think, oh, it'll come back. And if they make money, they think, well, I'll ride the winner a little longer. But that may violate the process.
Yeah, to a little bit. I mean, I really try and adopt a bit of a buy low, sell high type of strategy. It's very simple, but for whatever time frame, if I'm in a trade for 2 days, I might be using 120-minute period to look at that to come up with my conclusions about how I'm going to act. And if I'm doing something that I think is going to be a trade for a year, I may be looking at it from a weekly perspective. But being able to get in at that key entry point before everyone else is on board is key to success.
Well, and therein lies the magic. You work with Phil heavily on his research platform. What does he call that?
Erlanger Chart Room.
All right, and that is available to the Masters of Money, for example, as an online product.
Absolutely, and it's a great product. Quite honestly, the only differential between what the individual gets and what an institution gets is about a 20% differential, and it's just going five layers deep of the onion as opposed to 3 layers deep.
Well, right there, if you'd like to learn more about Phil Erlanger's chart room, write me at questions@safefinancial.org and we'll get you that information right away. I know a number of people who've used it and they've had great success with it. Now, that doesn't guarantee you will. Depends on how you use that tool. That's something we all understand. But it is something you should definitely consider. Move a little bit into Superstock. How does that help the Masters of Money improve their performance?
Superstock is nice because we have a process. Every morning, we're putting out a stock scorecard where we're evaluating a company and telling you what we think about it. And it's based on looking at cash flow, the return of capital, the cost of capital for that business to run, looking at earnings, and we come up with a number. And so we give examples of companies that are undervalued and companies that are overvalued. So each day an individual is getting to see that. And then we scan through the news every morning and come up with what we think are the most interesting articles. Today, Monday morning, January 26th, we talked about Merger Monday. We had 3 big mergers today. And so that's a key concept we want to think about. We want to be looking for companies that could be potential acquisition candidates that could get acquired for nice premiums.
Very powerful stuff. And as we talked in the first half of the program, the Society to Advance Financial Education is now creating safe investment clubs around the country. One of the key inputs to the safe investment clubs is going to be the super stock investor information. And that is applicable on relatively small amounts of money, right? It's not one of these you got to have $1 million to make it work.
Oh yeah, you could run it with a $10,000 portfolio. I keep it very simple in that we have a couple portfolios. The most simple portfolio is the Morning Matters portfolio. It's a 12 stock portfolio. And it has about 120% turnover a year. So that means 18 names over the course of a given year. And it's done very well. This last year we were up over 30%, and we started that in April of 2008, and it's up in that time period 480%.
Folks,
with low turnover. I mean, we're holding names and sticking with them.
I've spent 25 years in financial services, and I've heard claims from high to low and every other way in between. My friend Geoff tells you a number, I believe it. So when you say you were up 30% last year, that's a pretty darn good return when the market was up, what, 8 to 10?
Yeah, a big contribution to the performance were 2 names in particular. We own Celgene, which is now about a 75% gain, and we were able to ride that nicely. And recently, we added Bristol Myers. And the interesting thing about Bristol Myers is that we bought it in July, and Jim Cramer, the madman, who is actually, I think, a very brilliant guy, but he hated it at that point. And only when it got to $62, all of a sudden he liked it. So we come into stuff before it's necessarily popular with other people, and the blending of the fundamentals with the technicals is key to that process.
Now, folks, we talk about upside gain, and that's important. But if you recall a couple of Masters of Money shows ago, I talked about understanding downside risk. Give us a sense, Geoff, of the types of drawdowns you have. Because if you're hitting 80%, you're losing 20. If you're on super stock, you're winning in aggregate, you might be losing in the short term. What kind of drawdowns do you have?
The drawdowns aren't that big, and I typically put stops in place to look at things. On a stock, typically 15%. Options can be a little more volatile, so I'll allow bigger stops, typically 25%, before I'll look at it and figure out what I need to do with things. But I really try and come in at a low point where the stock has found a level of support, and it's really not going to go much lower from there. So we tend to do pretty well. I mean, our biggest risk is that we buy something and it just sputters around for a period of time before it makes money, before it really starts to make money. I mean, we bought Ford at $13, 13-ish. I don't know the exact price, and it's been as high as almost 16, and it's back around 15 right now. And I'm fine. I'm like, it'll get to where it's going to go to. It just may take some more time.
Yeah, we've talked about Ford. We've talked about the quality of the management, the release of the new F-150 pickup truck, and that was a super stock idea several weeks ago. So we're pleased with that. But as you go, and then everything then you do, you would put in risk control in order to help mitigate the downside.
Yeah, I mean, this goes back to I call them Philisms. He has great concepts about how to look at things, and he has 3 really simple ideas. The first is you need to know what the bias is. Do you want to be long, or do you want to be not long? Or some people will short stocks. We don't necessarily advocate shorting stocks for individual investors, but it's an option. So we need to know what the bias is. Then we look for setup indicators. Is there a lot of short selling going on? Are people betting against the company? Our options have hit an extreme after a stock has made a move down. And what's its seasonal tendency? Just like it's cold here in Chicago today and it snowed, stocks have seasonal tendencies where they do really well or they do very poorly. And then the third thing we do is we look for triggers. So we look for our entry point. We're looking for a key point where we're at an inflection and we're going to go up as opposed to going down. And if you blend bias, setups, and triggers, you can get some wonderful results.
Folks, this is going to be interesting. We talked about the safe investment clubs, and here at the Chicago Master of Money program, we're going to be launching an investment club shortly, and you can see why I'm excited to have Geoff and the research of Superstock, Quantitative Partners, and Phil Erlinger involved in what we're doing. It's going to be a terrific run. Well, Geoff, I appreciate your coming out. We're going to break for the night. When we come back, though, and future programs, we may have you come in. You Skype, right?
Yeah, I Skype. And I also live up in just a little north of you in Madison, Wisconsin.
Unlike today, so, it's not so terrible.
Yeah. We'll have to, as we get to warmer weather, we'll schedule some golf games around it.
We absolutely will. Well, folks, thanks for being with us once again for this Master of Money. Next week, we're going to bring you new insights on how to continue building your path to prosperity. And as always, I want to thank our sponsors, Harvest Investment Services, who gives us use of this beautiful facility, Superstock Investor, where Geoff and his colleagues bring us such good ideas. And we want to thank Ron Blake Music, who provides the music at the front end, and Chris Yantz, who's custom written our theme song at the end. We thank all of the participants, and mostly, we thank you for sharing your time with us each and every week. So join us again next week as we present to you another edition of the Master of Money.